Alright guys, in today's video, we're going to be talking about 3 of my favorite dividend stocks that I own myself for the long term. And just to make things more interesting and give you a wide variety of different stocks to look at, we're also going to do, at the end of the list, we're going to do a rapid fire of 7 bonus dividend stocks for a total of 10 different dividend stocks. So we'll spend a little more time on the 3 that I own, and then 7 bonus ones that I either also own or that I am tracking very closely. And a lot of these stocks are either up a lot or they're down a lot. Some have very high dividend yields, some have low yields, some are growth stocks, some are value stocks. So there's a wide variety of stocks. So I really hope you guys enjoy this. But before we start, just 2 really quick disclaimers. Number 1, please always do your own research and make your own decisions. I'm not telling you to buy or sell anything. And number 2 is just to give you a little bit of context about who I am and what I do. I'm a long-term investor who likes to buy stocks over many years, and I usually do most of my buying when stocks are going down, when there's dips, when the market has a correction. I buy much more aggressively during those times. So just because I show you a price of a stock trading at the time of this recording, it doesn't mean that I bought my entire position at that price, or that I'm even adding at that price. I usually wait for the stock to kind of come back down a little bit, or for the market to have a little dip, and then that's usually when I do a lot of my aggressive buying. But that doesn't change the fact that I still really love the stocks that we're going to talk about in today's video, and that I'm always kind of looking for buying opportunities with pretty much all of these stocks. But we'll go through them one by one, so it'll be easier to understand. Anyway, I really hope you guys enjoy this video. Sorry for the long-winded explanation. If you enjoyed the video, please consider hitting the like button. It really helps support the channel, helps it survive and grow, and it means a lot to me. But with all that said, let's go ahead and get started. What's up everyone, my name is Ale. Welcome back to my world of stocks. Let's go ahead and start with stock number 1, and this one also happens to be my biggest investment in my entire portfolio. It's one of my absolute favorite stocks for the very long term. So when I say long term, I mean like 5 to 10 years out or more, and this is one of those stocks that I could see myself owning maybe for the rest of my life. But this is the mighty Microsoft. Ticker symbol is MSFT. Now this is one that I've been buying very heavily for a long time now, mostly at or below $100 a share, but the stock recently popped this year, having already climbed by 33% year to date, while also being up by over 200% over the past 5 years. So it's definitely a stock that has been performing very well over the long term. I do think that the valuation is a bit high at these current levels with a forward PE ratio of 22, so I'm currently waiting for a little bit of a dip in the stock before I really add more heavily to my position. But even at these levels, I still think that it's a great dividend stock for the long term, and one that I have no plans of selling anytime soon. Now, most people don't think that Microsoft is a great dividend stock because the yield is pretty low at just 1.3%, but with a reasonable payout ratio of 43%, a double-digit 5-year growth rate of over 12%, and almost a decade of consecutive growth, I actually think that Microsoft is a compelling dividend growth stock that should offer gains from both the stock price and the dividend when you consider their amazing business and how well the company is being run. In my opinion, they have one of the absolute best CEOs in the world in Satya Nadella, who has helped shift the company's business to be primarily focused on cloud integration with Microsoft Azure, which is already the second largest cloud service in the world, only behind Amazon, and is actually growing at a faster rate with 64% growth last quarter, while Amazon only grew by 36% and conceded some of their market share as a result. This growth in cloud computing is also leading to massive progress for Microsoft in areas like autonomous driving, artificial intelligence, machine learning, and deep learning, while also complementing other parts of their business like Xbox gaming, which is getting closer and closer to being the first Netflix-like service for gaming with Xbox Game Pass. Azure will also fuel Project X Cloud that will allow gaming on practically any device through the use of Azure servers, where games will be run in the background at high performance and then streamed to your weaker device for a subscription fee. They also own LinkedIn, which is a huge platform for professionals with over 500 million users, GitHub, that is the biggest platform for programmers and developers, and of course they dominate virtually all computing markets thanks to their Windows operating system that commands close to 80% of the market, which is well ahead of both Apple and Google. And of course, who can forget Microsoft Office software that is used by most businesses and schools across the globe. All of this has led to amazing performance, with their sales topping $125 billion last year and are still expected to grow at a double-digit percentage in the next couple of years at 11% each, with their profits also expected to soar at nearly 15% per year over the next 5 years, which should only strengthen their already monstrous balance sheet even further. Just their current assets alone can easily cover both their current liabilities and their long-term debt combined. And it even comes close to covering all of their liabilities in total as well. That's a big deal because all of this money can easily be used to continue fueling growth in the future through investments in R&D and even acquisitions like the brilliant ones that they've already made in LinkedIn and GitHub. Like I said before, the stock is a little high at this moment, the valuation is a little rich, and because this is already my largest investment, I'm not exactly eager to add to my position at these levels. But give me any kind of dip on this stock, give me any kind of market correction, and I will not hesitate to buy an enormous amount of more shares of Microsoft, despite the fact that it's already my biggest stock, because it's just a company that I really believe in for the long term. In fact, if I could only own one stock in the entire market, it would probably be Microsoft. Number two would probably be Amazon, and they'd probably be in contention. But Microsoft, I think, would probably take number one spot there. Okay, so we just talked about Microsoft, my number one largest stock, and then we quickly mentioned Amazon, which doesn't pay a dividend, but that is my second largest stock. So we might as well go to my third largest stock, and this is one that is very similar to Microsoft in the sense that their dividend is very small, but it's definitely growing. And it's also a company that I consider a lot safer for the long term, and it's one that I really believe in myself. And that company is, of course, Disney, and the stock ticker symbol is DIS. Okay, now taking a look at the stock, like I said before, it's very similar to Microsoft, and also in the sense that I've bought this stock very heavily at under $100 a share, but it's one that I've been buying for many years now, and most recently the stock has been on a tear, climbing by over 22% this year alone, and is currently up by almost 50% over the past 5 years. As far as their valuation goes, you might be surprised to find that their forward P ratio of almost 23 is actually higher than their trailing ratio of 17. However, there is actually a logical reason for this. See, Disney is currently investing very heavily into upgrading their theme parks with new Star Wars and Marvel experiences, but more importantly, they're also launching a new video streaming service in November called Disney Plus that is aiming to challenge the likes of Netflix and Amazon Video in a market that is worth about $25 billion according to Statista. And it's one that will likely get even bigger in the future as people continue to cut the cord. And the great thing for Disney is that they acquired 21st Century Fox assets to add even more content to their already incredible library of strong brands and IPs like Star Wars and Marvel. So Disney Plus will leverage many of those brands, including their huge backlog of Disney shows and movies, to offer a compelling service that will only cost $7 a month and can even be bundled with Hulu and ESPN Plus for only $13 a month. For context, Netflix already charges $13, and that's for only one service versus the 3 services that you would get from Disney. And it was recently announced that Disney will also be adding an Obi-Wan Kenobi show, which I think could be a huge deal and help attract a ton of Star Wars fans to the service that adds to the already robust lineup of Star Wars and Marvel shows, including The Mandalorian that is set to have a budget similar to Game of Thrones, and numerous Marvel shows that feature actors from the blockbuster movies. But of course, all of these investments do come at a cost, which is leading to their EPS dropping by 19% this year before returning to growth the following year, and that has led to the higher PE ratio. However, it's the long-term picture that needs to be focused on, as it is also leading to very high sales growth. You have to remember that this is a company that already did close to $60 billion in revenue last year, yet they're now expected to grow sales by an enormous rate of 17% this year and 19% next year, which is coming off of only tiny growth of just 6% in 2016, an actual decline in 2017, and then only 8% growth in 2018. So this is really about the future more so than anything else, where you're going to see much higher growth for an already enormous company. Not to mention that Disney is still very well diversified with other parts of their business, like their blockbuster movies that saw their studio segment climb by 33% last quarter, while their theme parks and resorts across the world, like Disneyland, think of the Disney resorts, think of the resorts in Hawaii, think of the cruise lines. All of those continue to generate billions of dollars every single quarter, and they still managed to grow by 7% last quarter, despite having been around for so many decades already. And while you wait for that brighter future to take shape, you still get a decent dividend in the meantime. Now, their yield is low at just 1.3% right now, but with a payout ratio of just 28%, a 5-year growth rate of almost 15%, and already a decade of consecutive growth since they started paying it, I'd say that Disney is also a very solid dividend growth stock for the long term. Okay, so we just talked about Microsoft, we talked about Disney, two stocks that are very similar, kind of low dividend yields, stock prices that have been performing very well lately, and stocks that people usually consider safer for the long term. So with stock number 3, let's go ahead and just do the complete opposite, and let's take a look at a stock that is down huge right now. It's a stock that crashed, and I started buying after it crashed because I couldn't resist anymore because of two reasons. The valuation got very attractive and the dividend yield is very high. And so that company is a biopharmaceutical giant called AbbVie, and the stock's ticker symbol is ABBV. Now, in the past 5 years, they are still up by close to 18%, but more recently than that, they have lost close to half their value since their highs in early 2018, having now dropped to just the $60 range, which is where I started buying the stock myself. When looking at their valuation, their PE ratio is very low at just 7 forward, and their dividend is equally attractive at over 6.4% yield. And while it only shows 6 years of growth, it's important to note that AbbVie was spun off from Abbott Laboratories, who up until then had been growing that dividend for several decades, so their dividend growth history should be considered much larger than what is currently shown. In any case, the stock has crumbled due to their best-selling drug called Humira losing patent protection in Europe, and that's led to biosimilars crushing their sales as Humira dropped by 6% year over year in the last quarter. And things may only get worse in the future, as they will also be losing patent protection in the United States as well in 2023. However, in the meantime, AbbVie has made a lot of moves to help offset the declines with new drugs and treatments that are spurring growth in areas like oncology, which grew by 38% last quarter, and a number of other new drugs in the pipeline that are expected to do billions of dollars in sales in the future as well. Not to mention the recent acquisition of Allergan that Wall Street hated as the stock sold off, but I'm a bit more optimistic because of two primary reasons. Number one is that it lowers their dependency on Humira from 57% to just 40%, while also providing cost synergies and adding research and development to certain areas that they already wanted to expand into. And then reason number two is that it also adds even more cash flow to the business by billions of dollars. Now, their sales are only expected to grow by 1% this year and 4% next year, which is a huge drop off from the 16% that they saw last year, but I also think that the stock has already been punished for that. And while I absolutely hate their balance sheet that is just loaded with enormous debt, I think it can still be paid down over time thanks to their enormous cash flow that is expected to grow by nearly 40% next year and top $15 billion of free cash flow the year after. In the meantime, this is a stock that I would like to buy a little bit more of. Right now, it's about 1% of my portfolio. I would like to increase that to about 5%. Usually the smaller stocks in my portfolio I keep at around 5 to maybe 10%. And AbbVie, just because they have so many headwinds, because of the really weak balance sheet, I would like to cap it at about 5% just to kind of limit my risk. But I still want to collect that dividend, and I do feel that the stock is oversold at this point. I think Wall Street has beaten it up a little bit too badly, because I do still think that they have some potential in the future and they can kind of turn things around, and they generate so much cash flow. So that's why I still want to own this stock. By the way, I'm not the only one who thinks that this stock is probably oversold. If you look at insider trading for AbbVie, it looks like the management team has been buying up shares like left and right lately. They've been buying a ton of shares, so they probably also feel that the company is kind of undervalued at this time. Alright guys, so those are some of my personal favorite dividend stocks for the long term, and all three of those I am personally invested in myself. Now, if you're still thirsting for some more dividend stocks and you want to see a bigger variety, then stay tuned because we're now going to do a rapid fire of 7 bonus dividend stocks. And some of these I own, some of them I do not own, some of them I would really like to own. And I'll let you know as we go through them one by one, which ones I own, which ones I don't. And anyway, there's going to be a wide variety. Should be very fun. Let's start that right now. Okay, honorable mention number 1, that's going to be Visa, ticker symbol V, which is the payments processing giant that collects a fee every time you use one of their services. Not a huge dividend on this one with a pretty low yield of just 0.56, but with a payout ratio of less than 20%, a 5-year growth rate of over 20%, and over a decade of consecutive growth, Visa has all the potential in the world to grow that dividend much larger in the future. The only problem that I have with Visa is that the stock rarely dips, and I know that's a weird problem to have, but I'm someone who loves to buy stocks when they're going down, so it's been very difficult for me to find an attractive entry point. But considering that they're already the market leader and are still growing sales by double-digit percentages, I'm probably just going to end up buying Visa even without a dip, because it's a company that I really believe in and I really love their business and their performance. So anyway, that's Visa. Moving on to stock number 2, we're going to go with AT&T, ticker symbol T. And this is a stock that I bought myself in the high $20 range because it had been crashing by almost 40% at that time, but it has since climbed by over 21% this year, where it now sits near the top of their 52-week range. So I've stopped buying the stock for now. But even at these levels, their PE ratio is still less than 10 and their dividend yield is over 5%. Although my personal yield is actually over 7% because, again, I bought the stock much lower, but they've also been growing that dividend for 35 straight years, which is gigantic. Now, on Seeking Alpha, it only shows 16 years, but that's probably just some sort of glitch. It should definitely say 35 years. Anyway, AT&T does have a ton of problems, but they're really a transitioning company right now that plans to launch a video streaming service next year called HBO Max that will launch with over 10,000 hours of content, and they're also a big play on 5G, as they'll be rolling out nationwide 5G next year as well, so it's definitely a stock worth watching, especially going into 2020. I do think it's a little expensive at this current price, but anything under 30 I would definitely be willing to add to my position. Okay, now stock number 3 is going to be International Paper, ticker symbol is IP, and this is a paper and packaging company that is also a huge play on the rise of online shopping, and it's one that I've always kept an eye on. I don't personally own the stock myself, but it's one that I always kind of keep an eye on, and I've always been kind of tempted to buy the stock, but for one reason or another, I've just never added it to my portfolio. But one of the things that I don't really like about International Paper is that they do have a lot of exposure to the global kind of macro economy, and with the whole trade war going on, their growth has taken a hit, and Wall Street has sold out of the stock, sending it crashing by 33% from their 52-week high. But when a trade deal does get done, this could be a stock that really starts to recover, considering what a big play packaging companies are on the growth of online shopping that is expected to climb to almost $5 trillion in just a couple years, while still being only 17% of all retail. And in the meantime, all the negativity has left the stock with an attractive valuation and dividend, as their forward P ratio sits at less than 9, while their dividend pays out a mouth-watering yield of over 5%. And that's with a reasonable payout ratio of only 40%, almost a double-digit growth rate of 9.3%, and almost a decade of growth to go right along with it. Not a stock that I own myself again, but it is definitely one that I enjoy tracking, and I may own in sometime in the future. Okay, now stock number 4 is going to be PepsiCo, ticker symbol PEP, and they're obviously famous for owning Pepsi, but they also own famous brands like Gatorade, Mountain Dew, Naked Juice, and even non-beverage brands like Quaker and Frito-Lay chips, which includes like Doritos and Fritos and all that kind of stuff. And they're even tackling the growing sparkling water market with their acquisition of SodaStream and their launch of Bubbly. Unfortunately, the stock is a little too high for me to buy at this time, as they're currently sitting near record highs with a forward P ratio of over 22, but I have to admit that their dividend is still very attractive even at these levels, with a yield of close to 3% and a gigantic growth history that is quickly approaching 50 consecutive years of growth. That's even through recessions, market crashes, all that kind of stuff. And even with all that growth, their 5-year average is still about 10%. So if PepsiCo was to see kind of a decent sized dip, it's another one that I would definitely consider buying myself. Okay, now stock number 5 is a stock that I do happen to own, and it's actually the only bank stock that I've ever purchased myself, and that is JP Morgan Chase, ticker symbol JPM. And they currently sit near the midpoint of their 52-week range, mostly because bank stocks have been taking a hit lately with all the recession fears and the Fed cutting rates. But I've remained in this stock as a long-term position because, in my opinion, I think this is one of the best run banks in the world. So with a forward P ratio of only 10 and a dividend yield of 3.4% with a low payout ratio and a high 5-year growth rate and almost a decade of consecutive growth, this is another attractive dividend stock that I think is worth holding on to over the long term. Okay, now stock number 6 is going to be NextEra Energy, ticker symbol is NEE, and I'm not personally a big fan of energy stocks myself, but the reason why I really like this one is because they're one of the biggest players in solar and wind in the entire world, and I really think that that may be a future that we're headed towards eventually. So for that reason, I've always kept a very close eye on NextEra, and it's one that I've definitely wanted to buy. But unfortunately for me, the stock is trading very high at the moment as they sit close to record highs. So if they ever dip back down, then this is another stock that I would love to pick up at some point. But currently they have a forward P ratio that is a little high at 24, and while their dividend yield is a little low at just 2.2%, with a payout ratio that is also a little high at 60%, they do have a 5-year average of almost 11% with close to 25 years of consecutive growth. So I think it's still a very attractive dividend stock if you're also looking for a big play on the future of renewable energy. I just think it's better to wait for a little bit of a dip on this one. Okay, and finishing off the list here at stock number 7, we're going to go with Tapestry, ticker symbol TPR, and this is a stock that has definitely seen a dip. It's one that I do not currently own, but I have to admit that it's been catching my attention lately because the stock has been absolutely destroyed, dropping by over 60% from their highs last year. Now, this is the company behind some big higher-end brands like Coach, Kate Spade, and Stuart Weitzman, and they've been struggling with growth, especially in the Kate Spade brand, but they are still expected to grow their sales by 2 or 3% in the next couple years. So I think the sell-off in the stock is maybe a little overdone, considering that their forward P ratio is now only 7.45, while their dividend is also yielding a monstrous 6.5%. The only issue is that it's not really growing anymore, so if you're looking for a dividend growth stock, then this is probably not the right stock for you. But to be fair, that dividend has at least been paid for a while now, since 2009. Anyway, I'm not really into women's fashion, so this wouldn't really be a great fit in my portfolio, but I have to admit that at these levels, I've definitely thought about buying this stock several times, and who knows, maybe I'll end up buying it at some point. Okay, so that does it for today's video. What did you guys think? Let me know your thoughts and comments down below. How do you feel about any of these stocks? Are any of them positions or any of them stocks that you happen to own yourself, or any of them stocks that you've been thinking about owning? And did I leave out any dividend stocks that you would like to add to the list? Let me know down in the comment section, and who knows, I may actually make a video in the future about that stock. So leave your thoughts and comments down below. If you enjoyed the video, make sure you hit the like button, subscribe if you haven't already, really helps the channel, and I will catch you guys in the next one. Thank you for watching, take care, bye-bye.